This is For Advisors by Advisors. I'm your host, Evan J. Mayer. Today, we have a special guest, Mr. Mike Boatman. You like Michael or Mike?
Mike's fine.
Mike's good. So Mike Boatman is the Senior Vice President of Capitas Financial. Mike handles insurance for almost all my clients. I've been using Mike exclusively since 2012. So it's actually our 10-year, it's just over 10 years working together, which is pretty cool. So a little backstory on Mike and kind of what Mike does. We would call you a general agent. Would that be fair?
Yes.
Yeah. So Mike works for a general agency, and I had joined SunTrust back in March of 2012. And when I joined, they said, you got to speak to Mike. We have an insurance partner. And at my old firm, we didn't have an insurance partner. We didn't really focus a lot on that. And as I was growing my practice and getting into financial planning, I thought it was interesting that there was somebody that does that. And I said, well, does Mike do all the paperwork? and Mike said, yeah, I can help you with the paperwork, but I do a lot more than that. And I'm like, well, if you do the paperwork, I'm game. And since then, I'd say, you know, between the multiple families we've helped and multiple clients we've helped, we've probably done somewhere north of 50 policies. And I would say we probably put people through underwriting or at least looked at their insurance policies, maybe 300 to 500 different policies we probably looked at throughout the years, I would say. So, and what I love about working with Mike specifically is that he is client focused, client centric, and always does the right thing. And to me, as a financial advisor, we have to wear many hats. We have to focus on many different areas. And the fact that we can have a partner that specializes in an area like insurance and make sure that the client has the right fit is a huge value add to the client. And it's a huge value add to the advisor. And it helps solidify our relationships with our clients, which is very important. So Mike, why don't you give us a little backstory on you, kind of when you started in the business, where you've been and where you are today?
Sure. I was recruited into SunTrust about 20 years ago. This is my 21st year in the business. It was an odd sequence of events how I came into SunTrust, but I was a younger insurance advisor. The bank was branching out. I think I was the third internal insurance specialist that SunTrust had hired in the footprint because the program was expanding. I was with SunTrust internally for about 8 years, had moved into the GA space, and now I'm currently with Capitas, and I've been with a couple other GAs that have serviced, customers of the GA space, which is the major banks, wires, firms, and independent advisors.
And how long were you at SunTrust for?
Card carrying member for approximately 8 years.
And when your coverage area, like, I think at one point it was like all of Florida and wherever insurance maybe was, but
it was a little too much of a territory. I told my boss at the time, when I start losing my radio stations, I know I'm out of my territory.
Got it. A little far from home too. Not the best on family life per se. And so when you left SunTrust and you went to some of these other firms, what's the biggest difference between GA to GA? And first of all, why don't you tell us what a GA is? Because I think there's a lot of advisors out there that do not currently work with the GA. And what's the benefit of working with the GA?
So with insurance, there's manufacturers of insurance. That's your John Hancocks. That's the providers, your John Hancocks, your Lincolns, your Transamerica, so on and so forth. They manufacture the product. They don't distribute it. The general agents distribute the product. So we distribute the manufacturer's product, and all product lines that they offer go through a general agent. Now, there are some one-off insurance companies that are direct distribution, but those firms are not in the major banks and wires.
So like a John Hancock as an example, not pointing them out, but John Hancock, MetLife, Lincoln. If I'm a financial advisor working in one of the banks or wirehouses, do I need to go through a general agent?
Most firms mandate that you do go through a general agent for compliance and other reasons, and to make sure that somebody's an expert in the space is flying high cover.
Got it.
And there's typically a revenue sharing agreement that's done at the executive level, and there is a revenue sharing agreement put in place.
For that. So the advisor technically doesn't per se get hurt by working with one.
No, the compensation is very in line with what most advisors would get if they didn't go through someone like me, because you still have to process through a GA.
And the independent advisors, they could go direct, but some firms not,
prohibit that.
Got it. Okay, very cool. Very cool. And what I've always found helpful about you is that when, we're looking at an insurance case, we've already done a financial plan for a client. Actually, the first thing you asked me for is, Evan, where's the financial plan? Which actually is a great question to ask an advisor, because at the end of the day, how do you know what kind of insurance the client should have unless you've looked at that financial plan? How many plans have you looked at?
Thousands.
Yeah.
Thousands. When my prior life, I was attached to the hip of the financial planning group. We spent, hours together. And what comes along with a financial plan is just to give you the hard data, because then I can go back to the advisor and ask the soft data, because insurance does have a sleep factor to it. It's what's the sleep factor and what does the family care about emotionally?
Yeah. So when you're looking through the plan, I mean, obviously everything is encompassing of that. What are the holes that you're looking for in the plan where the insurance could actually come into place?
There's 3 or 4 basic types of concepts for insurance. There's people that are savers and they've got young families. And those types of family needs very simple solutions, low cost, generally term insurance, very straightforward. That's the easiest segment to work because you're just replacing an income for, because the family's is an income earner. Number 2 is legacy planning. They're older, they're more established, they have wealth, they're not going to run out of money, and they care about leaving money on generationally or downstream, and they want to do it in a tax efficient basis. Insurance is one of the most tax efficient ways to pass money on, particularly on a guaranteed basis. It's a non-correlated asset in an unknown interest rate environment and an unknown economic environment.
And, lately, I would say over the last 5 or 6 years, I have not done traditional long-term care because the life insurance with long-term care riders seem to handle a lot of different areas. And then the client doesn't necessarily have to worry about premiums increasing. Can you speak specifically to what you've seen going on in long-term care regarding premium increases and the benefit of life insurance with long-term care riders?
Long-term care originally came out, I believe, in John Hancock in 1984 was the first rendition of it. And that was the new segment market. All the major insurance companies jumped into traditional long-term care. The baby boomers are retiring. It's not a death event. It's a healthcare event, and retirement is the most impactful. John Hancock, GE, and all the companies who issued those products, they mispriced them. They assumed the average claims would be X, and they weren't even close to that. A couple of years ago, I was at a convention and I learned that the largest claim still being actively paid was 2.1 million in benefits. So they mispriced the book. The insurance companies went back to the various state insurance commissions, and in Florida being very senior heavy, and they agreed to get various rate increases over a period of time so that the company didn't go bankrupt or insolvent and they couldn't pay claims, because the idea is to, we're insurance companies to pay claims.
Yeah, to make sure the money's there when it needs to be there.
Correct. So families have gotten rate hikes. They're not happy about it, but when you explain to them that they're still paying 2x, 3x below the going rate, it puts it in perspective a little bit.
Yeah, it's actually interesting you say that, because most of the long-term care policies that I've had you look at in the last 10 years, I would say 95 out of 100 of them, you said, these are great policies, keep these. I mean, these are golden policies.
Correct, because you couldn't replace that for 2 times the cost for the benefits that were offered, and those benefits aren't even offered today. But what the insurance companies did is say, look, why don't we start developing riders? Because back in 84, 85, and even the 90s, there was 3 or 4 products on the marketplace. Some of those advisors still sell those old school products, and really they should have evolved. Today, there's probably 30 different products and 20 different companies that offer some form of critical illness or long-term care type of contract. What was nice about the riders to bolt them onto a life insurance policy is the insurance companies know what they're on the hook for. So if you have a $500,000 insurance policy, Mr. Actuary knows we're only paying out $500,000. We may pay it out over time. We may pay it out lump sum. We may pay it out tomorrow. We may pay it out in 30 years from now. But they can take that and actually calculate it and project risk, where the other policies, because of the continued benefit, it was impossible to predict the risk.
So they've been able to price those fairly, where the client is getting a good price, but the insurance company obviously is making money.
Correct. And sometimes we meet with families and they're just a pure life insurance need or a legacy need, and you'll show them with the rider and without. And because the cost is minimal of an increase, depending on your age, they add the rider.
And what I've noticed about working with you, and again, I don't have experience working with a ton of people, but again, I think insurance is one of those areas where trust is the most important factor. You work with multiple different companies dependent upon the age, the sex, other determining factors. Can you speak a little bit, because this is an area that I don't know a lot about, but through my LinkedIn, and again, this podcast is for advisors by advisors. It's directed for not independent advisors, but all advisors, bank channel advisors, insurance channel advisors. The insurance channel advisors specifically, there's some proprietary products. Some are good from what we've looked at in the past. And you're like, I think Northwestern, that's a proprietary company, right?
Correct.
And I think there were some policies there that you thought real highly of. But then there were other policies proprietarily that you did not. Can you talk a little bit about that?
Sure. It goes back to ethics. Whether you're in a captive marketplace or an uncaptive marketplace, you can manipulate software to manipulate product to what your end game is. So it may say XYZ insurance company on the top of the page, which may be a great insurance company, but the person who did the underlying design had their interest in mind before they had the client's interest in mind, meaning commissions.
So even the policies that per se are bad, a lot of those are chalked up to how the insurance rep designed that specific policy.
There is some merit to that, but we've also been in a declining interest rate for 30 years, and that's affected all insurance contracts. That's why advisors need to review insurance, because they are interest rate sensitive. And if they sat in a drawer for 30 years and they didn't follow the interest rate trend, they could have made a tweak or a small adjustment some time ago and the policy would have been fine. Because they didn't make that tweak and 20 years has gone by, the policy is not nearly what it once was. I reviewed a policy 2 weeks ago for a manager of a very large firm's mother, and the policy had never been reviewed. If that policy just would have simply been reviewed, it would have been worth its weight in gold, but nobody kept up with the economics, the underlying economics behind it.
So the economics didn't make sense. And that's that. I think every time I bring you an insurance policy, you ask for the in-force illustration. That basically clears it out right away, what the client's looking at. And, for those advisors that, do their own insurance and don't work with somebody like Mike. And again, I value working with Mike because he kind of handles that for me. Getting in-force illustrations, how often should an advisor get in-force illustrations on their policies for their clients?
It depends on the type of policy. If it's term insurance, it's set from the beginning so that those terms can't be altered. But if it's any sort of permanent insurance contract, which has some sort of interest rate sensitivity, whether that's in the market or not in the market, those policies need to be reviewed annually or an in-force maybe at least every couple of years. Because what goes along with that in-force review or that review is, Mr. Client, has your health changed? Has your situation changed? Because there's some things and some levers we can pull. Just to give you an example of a case last week, client has term insurance. They didn't review it. The conversion period expired. Now the insured has underlying health conditions that they can't secure insurance on the open market. If we would have reviewed that policy 3 years ago,
you could have converted it.
That advisor would have been a hero to that client. That client, he would have never left that client given this particular person's goals and objectives.
Yeah. So you would say, it's something that kind of, we look at insurance with risk together. And so when we do our risk tolerance questionnaire, and we do that once a year, we also look at the insurance at that same time. Some sort of systematic way of going about looking at those policies is needed for most advisors. And I'm guessing that that's not happening on a yearly basis most of the time.
It's not. Respectfully, advisors are creatures of habits, and the firms and the way they market and capital markets assumptions and rates of return and asset allocation, you guys have a lot on your plate. So to encompass that with insurance, if you have a partner like myself that you can just delegate, be in the initial meeting, understand what the client's goals are, and then I can run with the case from there. And it gives people like you to better leverage your time to get back to the things that you do best.
Now, one of the interesting things of working with you, and again, being friends with you for 10 years now, I started in the business when, back in 2002, but when I came to SunTrust, my book of business was quite small, and I was just getting my hands around planning and doing things the way that I knew was the right way. I would always ask you questions. And one of the questions I would pose to you was, what are the top advisors doing that I need to be implementing? So I'm going to ask you that now. What are the top advisors doing that needs to be implemented? And it doesn't have to be in insurance. It could be in anything.
A lot of the financial industry, in my opinion, has become commoditized. The robo-advisor, it's commoditization. A good advisor needs to find a way to distinguish himself of what makes him unique and why clients want to gravitate towards him. One, they need to show they care. Two, they obviously need to be competent. And three, you got to be there for your clients. And being there for your clients is not when the portfolio review comes in and it counts up 28%. Being there for your clients is the tough meeting when the client comes in and the portfolio's down 18% and the underlying capital markets assumption says it should be down 6, and the client's asking tough questions. That's when you need to be there for your client.
And if you were running a firm today, if you were running a big bank firm or a wirehouse firm, and you had the ability to hire in-house insurance specialists or to work with the GA, and again, take off the fact that you do work for a GA, take that hat off for a second, because I'm sure there are some good banks or good, I use banks a lot just coming from the bank channel, but I'm sure there's some good wirehouses and even some good independent firms that have internal insurance teams. Would you have an insurance team in-house? Would you not? And if it was in-house, how would you change it so that it's a little bit more independent per se for the client and for the advisor?
Sure. One, you don't want me running an insurance program inside of a bank, number one. But if I was tasked to be on a committee to help establish that, I would keep the GA model in place. I would not pursue an internal model. Over the last 25 years, any internal model that I've worked has had pockets of success, but every major firm has exited that business, and there is no internal card-carrying members of insurance specialists for most major banks or wires. I'm sure a lot of that has to do with economics and cost, because if you work with a GA, all the variable cost of hiring staffing is on the GA, and the bank advisor, who's the bank's clients or the financial advisor's client, you get a percentage of override. So you have a margin that's plus positive for you, depending on the resources that are deployed. And every bank and financial institution has holes in the country that can be readily, easily filled with a GA 2, maybe 3, if you really need to, depending on how large you are. And it's a much more economic cost structure, and we're really good at what we do.
So, well, we'll talk a little bit about that now. You're with a newer GA, and you were with an older GA, not to mention company names or anything, but what's the difference between working for a GA that you like better than the other GA? What's the difference?
I think there's 2 basic GA models out there. One that has gravitated more to technology and the robo-advisor, the robo-insurance, because in 15, 20 years from now, securing term insurance, probably even sooner, probably won't involve someone like me. It'll be, big data algorithms of issuing policy based on big data risk, which will be cheaper for the insurance company. But then there's also the type of GAs, and the one that I'm associated with now, that believes in their people. They back their people. We're a people first GA, and I have a team, an army behind me to get things done that better leverage my time and keep me helping advisors versus trying to find a 1035 form that can't be DocuSigned. It's got to be originally inked, and I got a trustee that lives in a different state and the insured in another state and the advisor in another state. And now you got a logistical concern. Got
it. Yeah, that makes a lot of sense. How has the insurance landscape changed for you, like over the last 10 years per se? And then not only then, but has anything changed significantly since COVID? Because COVID's come into the play. This is a major medical event, and how have the insurance companies changed or adjusted during that period of time?
The insurance companies who issued general issuance insurance with just a very quick medical, no true due diligence, what they call simplified issued. Those insurance companies in COVID took it on the chin with claims, because those were your substandard risk people who couldn't qualify for traditional insurance, and they layered in what they could. Now, those are smaller policies. They're not bigger policies, but actuarially, from what I understand, per Limmer stats, that there was a significant increase in claims.
And those claims could not be denied because this was a new virus that showed up?
Correct. The only time a claim can be denied, even if it's simplified issue and less than 2 years old, is there was a misstatement. What most advisors need to understand is simplified issued product, they don't pull medical records. So if the claim comes in within 2 years, they re-underwrite that claim. And I have seen claims not paid. The last thing you want is to think you have insurance, and little Mrs. Smith misrepresented her XYZ habit, and now a family thinks they're getting a check, and that check doesn't come in.
It's interesting you bring that up, because the first thought that came to my mind was, at my previous firm, they were pushing those a little bit more than traditional underwriting. And I think the concept obviously was easier. It's easier. Correct. It's easier for the financial advisor. That's pretty much 100% correct, right? Like those are just easier. But you brought up a very good point, which is, I've had many times, me and you have had clients that said they didn't do something, and they went through underwriting, and it's like, oh, wait, you didn't smoke, but there's nicotine. So where'd that come from? Or, you didn't smoke marijuana, but there's marijuana there. So, and obviously people want to hold that back because that's kind of, they're embarrassed by that to whatever extent. But you bring up a good point about the quick issue policies.
Yeah. And that's something that working with a quality GA partner, they can vet that opportunity, and the GA partner, the insured might say something to someone like me that they don't want you to know. So it's a good cop, bad cop scenario to help the client, because the last thing most people go, oh, I can just not talk about that. No, the insurance companies, they want to issue your policy and they want to pay your claim, but they've got to abide by their reinsurance agreements. And if they get a claim and it doesn't abide by that reinsurance agreement because the box wasn't checked, there's a family looking for a check that they're not going to get.
Let's go to the topic of mental health for a second, because that has happened a couple times. I was thinking like, no, my clients tell me everything, but there was a couple clients that had some mental health drugs that they were on. Mm-hmm. Maybe it was a little anxiety or something, but they got prescribed the medicine for it, and the insurance company declined them. Can you talk to a little bit about mental health? And because that's becoming a big factor now, and are the insurance companies up on it yet?
Sure. I mean, not to digress, but my dog was just diagnosed with anxiety. My dog is on anxiety medication.
Does your dog have a pet dog for the anxiety?
Squirrel.
Squirrel. Okay, good.
Yes, mental health is coming up more and more because of the world we live in today, and these things are going on. If they're situational and we know about it on the front end, you can craft a cover letter and work your way around it, because mental health medical records are subjective. It's not a math equation like a blood pressure reading or an EKG. It's subjective. So if we know about it, I can position it in a way that I can generally get it through. If we don't know about it and it comes up on the back end, underwriters are naturally pessimists, and they're going to go, well, what else don't I know about? So the more we know on the front end, it requires some due diligence. It does, and it does slow the process down, and most advisors don't like that. But that little extra due diligence on the upfront causes for a much smoother process in the back end, because it's a process. The biggest mistake an advisor makes about insurance, when the Mr. High Net Worth or it's a trust case or somebody of means says yes, and you don't set the right expectation. If you don't set the right expectation of what that process is, and when you want to secure 40, 50, 60 million dollars of insurance, an insurance company is going to do their due diligence and they don't care. So if you don't manage that expectation, you're going to alienate your high net worth client. And we do a good job of bridging that, because the insurance companies are notorious for dripping out information. Oh, we need this, we need this, we need this. And what we do is we get a list together, we get through the backside of it, and we call Mr. and Mrs. High Net Worth once and say, hey, we've got a list here. We need to go over some things we need to clean up. But it's one phone call versus 10.
And can you speak to financial advisors that we were talking a little bit about the difference between good ones and bad ones, and there's good and bad in everything, right? I was talking with somebody else about, good advisors at one firm versus bad advisors at one firm. And, I say to clients all the time, there's good advisors at every firm and there's bad advisors at every firm. And it's really the advisor you're working with. What makes the difference between a good advisor and a bad advisor when it comes to insurance?
One, during the initial sales process, if we agree there's a sale, the advisor's on the client's side of the desk. I'm over here. Now, if eventually it makes sense and the advisor sees that the client should do this because it's a cost, it's an expense, and you say the word insurance to a business owner, they cringe because they've been paying insurance for 50 years, whether it's workman's comp, auto, home. They spent a significant property and casualty. But at the end of the sale, if it makes sense, then the advisor's generally on the same side of the desk with me going, Mr. Client, you need to do this.
Yeah, and I sense that we've had a lot of meetings actually where we'll talk it out until one of us wins. And I like the fact that you are on that side of the sale call. I hate that word sale because I don't, I think it's we're filling a need, not a sale. But what I would mean by that is that, at the end of the day, we got to do what's right by the client. At the end of the day, you're doing that too. But because you wear a hat that has insurance on it, sometimes you look through those glasses.
It's a stigma.
And we have to look through the other set of glasses.
Correct. I love an advisor who, after we get through some sort of discovery of the plan, that they circle back and go, why are we doing this again? To validate it. And because it's a process, the client's going to come back to there eventually. It's not here, sign this form and we're done. Sometimes these things take months.
No, yeah, 100%. And a lot of times they don't work out, if it's the wrong fit. And, what I like about working with you, and this is just something I would suggest to all advisors out there, having a second set of eyes, even if you have an insurance person on your team that's specifically there for only insurance, I think that fits a very good bucket for your clients and for you to make sure you're covering all your bases. But at the end of the day, you're having a discussion on what's right for the client. I think there's many times that as financial planners, we get to a spot where we're kind of 50-50 on something. And we almost want to run that by another advisor. And I have a couple of advisors sometimes I'll talk to and I'll be like, hey, I'm kind of 50-50 on this. What are you thinking? So it's good to have that kind of partner, and would highly suggest it. Is there anything I didn't ask you that you think it would be important for the audience to know?
Given this is an advisor for advisors call, there is a trend in the industry to partner up in teams. The major firms are almost requiring, hey, we're going to take your grid pay ups, you do this, you partner. Now all of a sudden, there's XYZ of income there. Make sure if you're partnering with somebody and you have somebody on that team who's going to be noted as the insurance person, that they are vetted by somebody like me. I've known several teams that have somebody on their team that is known as their insurance wizard, and they're weak, but they can't share that with the team because that jeopardizes their own position within the team.
Makes a lot of sense.
So if you are working as a team or partnering up as a team, the teams that I've seen work doing this in 20 years are advisors that do not have the same strengths, that they complement each other. One may be good in fixed income, the other may be good in equities, but there's a complement. They're not clones of each other. And then whoever's going to be delegated the responsibility because most advisors do not want the label of I'm the insurance person on the team. They don't. To make sure that they're partnering with a good GA that can help guide them and grow their knowledge and help them. We're not here to go, your insurance advisor who you tagged insurance is not strong enough to handle Mr. High Net Worth. We're here to support them to make sure that we can handle high net worth as a team.
I remember when I joined SunTrust, there was a team of 3, and one was the insurance specialist, and he was very weak. And at the end of the day, you're right. There's going to be a little bit of a defense mechanism, so that's an important part. Why not have your GA review who you're bringing in as your insurance expert and make sure they actually know their stuff? Now, insurance people can disagree. That's another thing too. We've seen that as well. But I think it's good. I was listening to another podcast today, not to promote other podcasts, and they were talking about, it was an interesting podcast, but they were talking about decision making. And one of the guy, it came down to a decision where if you only heard one part of the story from one person, well, this person did a really bad thing. But if you heard the other side, maybe it's just a misunderstanding. And, having you to be there to vet that would make a lot of sense. So last question, one piece of advice that you'd give the audience that you want them to take away from this podcast today?
Advisors are creatures of habits. Most advisors generally mean well, most, not all. And from what my specialty is, I can't tell you the horror stories I've had because nobody reviewed policies. Grandma's got a $5 million policy. This is the last asset. They spent down everything else. This is for the heirs to live on, and we're just waiting for grandma to die. Well, the bill you're paying was $12,000. This is an actual case. The bill you're paying is $12,000. To keep that same policy next year, it's $210,000 for 1 year. So that I didn't even want to deliver the news. It was so horrific. And I knew what the outcome was going to be for the family. And so just please review it and get it to somebody like me. And if you just review it, move on and do it for 5 minutes. I'm just amazed at how many times I thought replacement 1035 business would have been gone because the insurance industry actually promotes product to replace product, right? 10 years ago. And the problem is not the product. The problem is they're not the advisor community, whether it's a advisor, a CPA or attorney or estate planning attorney, nobody's actually reviewing the mechanics of the contract. And so if you do anything with your clients, just say, hey, do you have any insurance? Let's just get a review. Just give me a statement. You get a statement to somebody like me, I can run with it from there.
And again, I just can't speak highly enough about Mike specifically, but look, Mike's down here in South Florida. If you're an advisor, you need help in South Florida, feel free to reach out to Mike. There's other good GAs he might know that are in other states or other areas. Mike, if anybody does want to get a hold of you for a question or, a thought, how could they get a hold of you?
Sure. I'm on LinkedIn, message me, accept an invite. I'm a pretty simple guy. I'm not real up on IT and tech, but you can link to me or give Evan a buzz and he'll give you my information. And one last thought. I can't tell you how many advisors now that work in different systems that I'm not associated with that from time to time call me and go, hey, what am I supposed to do here? Just because they want a good, honest opinion. I had one last week with a guy that I haven't worked with in 5 years. He goes, this is my situation. This is what my internal person's telling me we should do. Does this make sense to you?
That's great. That's great. And you're there to answer the call. And at the end of the day, this is an advisor community. I think, at the end of the day, we are competitors, but peers, and peers should look out for the client. And at the end of the day, I think that's excellent. So thank you, Mike. Thanks for coming on today.
Thank you, Evan.
For advisors, anybody want to get a hold of us, please email us. You can get a hold of us on LinkedIn, on our Instagram page. YouTube, we're on Spotify, Apple, anywhere you get your podcasts. It was great today. Thanks again, Mike, for coming in. And we look forward to our next show, and we'll see you then.